Hi there traders, and welcome to the latest video blog. Hope it finds you well and you had a good profitable trading week last week. So today what I want to concentrate on is the topic of how to trade markets that just don't seem to pull back. A couple of reasons for that. First, the main reason is I've received quite a few emails from people asking that very question. Tom, with the markets just falling or just rising, what's the best ways to get into these markets without getting terrible prices? And secondly is also purely because last week, even though it was a profitable week for me, I personally didn't make as much as I felt I should have made, purely based on this thing, this same concept of waiting for the best possible price. Sometimes you won't get it. When the markets are very one-directional, you won't get these ideal prices. So a couple of reasons to go through this topic today, which I hope will provide you with some different options to use with different market conditions, because we know market conditions are not going to be exactly the same every single time. Sometimes they're a bit range-bound and not really doing anything, and sometimes they're very, very trending. And based on what we talked about in the first video blog of the year, why I feel 2015 is going to be a very, very big year for FX, is the main reason why we're getting lots of trends, purely because the dollar, which is the major currency in the FX markets, is very, very strong right now, purely because of the American market. The dollar is really, really strong against a basket of very, very weak currency pairs. So we've got the euro, for its many, many reasons, is severely weak. Canadian dollar, for its many, many reasons, severely weak. The same for the Australian dollar, the same for the Kiwi dollar. We're seeing extremes between a strong dollar and a massively, massively weak other currency that it's paired against. And when you get strong and weak together, as we've mentioned before, you get massive, massive moves, which is great for us as traders because we need movements, but sometimes it's a little bit tricky trying to get in. Because for me personally, I'm like a person who goes to the sales to go shopping. You go there because you want to get a better price. I'm a bargain hunter. I'm always looking for a more expensive price to sell into or a cheaper price to buy into. The reason for that, I want to get the most efficient entry into the market, but sometimes by having that approach we can miss out on certain moves. So I'm going to go through the three approaches that you can take and what I personally take. The first is on the higher time frames, is ideally I want to see decent pullbacks on the daily chart. Reason for that is when it's on the daily chart, you're getting 300, 400 pip retracements, which means you're getting a much, much more efficient price into the market. So when the price retraces on the daily charts, we know we're getting a much, much better price to enter in at. If it's a downtrend, we're getting a more expensive price to sell at as it pushes back up. And in an uptrend, such as on the dollar CAD, we're getting a much cheaper price to buy at. So when it pulls back off its highs, we're getting a cheaper price to buy at. So it gives us that efficiency. But as we've seen on the euro dollar, we don't really get that many pullbacks. So this last big move down, it really hasn't pulled back. It's just been going down for probably 20 to 30 trading days. So no real option for it to pull back. The same with the Canadian dollar. We really haven't seen a significant pullback for 20, 30 days as well, probably a little bit more. Same with pound dollar. We've had a little bit more in terms of retracements. So we've seen some more viable retracements, but again, still some very, very big moves down without any massive retracements. And then finally, looking at the Aussie dollar, I've picked the most extreme. Again, we have had retracements, but we have had periods of time where it's just dropping, dropping, dropping without pulling back. So what you've got to bear in mind, if you are trading off the daily chart, you are going to have some times where you need to sit on your hands and be patient. However, that doesn't mean we can't get into trades. We just need to be a bit more realistic with ourselves that they're not going to give us these 300, 400 pip pullbacks. So with the daily charts, what I'm more concerned about is shallow retracements. So what I mean by that is if I'm using my Fibonacci retracement tool, you're probably looking at a 38% retracement rather than your 50 to 61.8s. So if we look at this previous retracement from the top here to the bottom just here, we see that it comes up and it reacts to the 38%. So a very shallow retracement, then we get that shift from buying into selling, and that initiates the big next move down. So you're going to find that you're getting much shallower retracements. Again, if we look at some previous ones, from this big move up here all the way down to this one here, again it's the 38% retracement, so very, very shallow retracements. Again, we should be looking for support and resistance. So again, if we find this just here, support becoming resistance just there. So we're still looking for our factors. We just got to bear in mind that on the daily charts, we may not get a significant retracement. It may not come back to the 50 moving average. So we're looking for some shallower retracement areas for us to get into, such as the 38% retracement, such as sharper trend lines that are more aggressive and that have a more steeper gradient. And also, if it's not reacting to the 50 or 200 moving average, what we could do is add maybe the 20 moving average to see if the market likes to react to that. So I'm going to just add in the 20 here. And there we see, yeah, we can see that the market is reactive and responsive to the 20 moving average. So trying to wait for it to come back to the 50 moving average, you're going to be waiting a long time. However, with the 20 moving average, it could happen in several days. So just bear in mind that if you are trading off the daily charts and the markets are trending strongly, you are going to get fewer opportunities. That's why we need to look for areas where the market retraces with a very shallow retracement rather than the deep retracements that we're often used to when the markets aren't as aggressive in their trends. So some of the reasons there are: use your lower moving averages such as the 20, look for some steeper gradient trend lines, and look for some shallow fib retracements such as the 38% retracements, for example. However, on the likes of the euro, we're not even getting any of that at all. So we're not even getting tiny shallow retracements, and we're missing out on these potential good opportunities. So if I can't find the opportunities on the daily chart, using the reasons we've just gone through, I will need to drop down time frames, because we may not get retracements on the daily charts, but we'll certainly get them on the lower time frames. So one of my favorite charts to trade off is the hourly chart. So I'm looking at the euro here. I'm just going to go back to a period where the trend is a little bit more cyclical. So here we go. This would have been on a move on the daily where it's just gone down and down and down with no clear opportunities to get in. However, on the hourly chart now, we are seeing some very, very nice retracements. So even though we're not getting 300, 400, 500 pip retracements, which we would do on the daily chart, we are still getting better prices to enter in the market at. Again, we're probably going to find that most of our retracements are quite shallow, so the 38% retracement. So let's just take one for example. So the 38% from here down to here. Yep, hits the 38%, and then we see that shift from green to red, and it initiates the strong move down. Why do we also like this? Well, it's also hitting the 20 moving average, so a shorter moving average, shorter period moving average. It hits the 20 moving average, hits our Fibonacci, and what else does it do? Well, we can see here that is a former level of support, 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 break support. What do we get? Support, then becomes resistance, and then we shift back down. We can again see that on many other occasions. So we see that the market then again has another sharp move down, retraces, inside candle, initiates the big move down. What does it also do? 20 moving average, pushes down strongly, and also previous support becoming new resistance. We can also use our stochastic to see if we are in overbought territory, or are we getting potentially any hidden divergence to support the direction we're going in. If you're still a little bit grey on hidden divergence, I have done a video on hidden divergence previously, so go through that. It's a very, very powerful concept. We can actually see it just here. So again, we go from this big start of phase one to the end of phase one. The market then pushes back up, gives us a decent retracement to the 61.8. What do we get? We get a higher high on the stochastic, but this is actually creating a lower high on the price action. So hidden divergence there. We do get an initial move, not as sinister as we do in these ones here, but it's still a half decent move off the top of that cycle. So the key element here is that the daily chart may not be providing you with many opportunities, but the lower time frames, I say the hourly, the 4 hourly, maybe even the 30-minute, are really useful charts to get these decent prices to buy at. To sell at in this particular example. We may not be getting those 300, 400 pip retracements that we'd get on the daily chart, but we're still getting better prices to enter at. Still, don't just trade blindly. Look for your Fibonacci tool. Look for your trend lines. Look for your moving average resistance. Look for your stochastic hidden divergence. Look for your price action. Again, let's just go through final example here. So from this top to this bottom, get a nice retracement, comfortably back up to the 50 moving average, reacts there, also reacts within our Fibonacci zone, and then we get this lovely rejection candle. So the buyers are tried but been rejected, and then the market pushes down and breaks its previous low. So that's where we'd be looking to sell at, just up here off this resistance level, getting a roughly a 40 pip better price than what we'd have got if we'd have been trading at the lows. So key element is to understand, why are you trading euro dollar short? Well, the reason is the euro is massively weak against the US dollar. So the euro dollar is a very, very weak currency pair. Then secondly, if we can't find the opportunities on the daily chart or the decent retracements on the daily chart, we're looking to drop time frames, of which the 4-hour, hourly and 30-minute will give you these retracements. Maybe not as large as on the daily chart, but still much more efficient prices to enter the market. And that will then give you the ability to just feel a little bit more comfortable with your trades, knowing that you've got a better price as well, a bit more confident. And you're essentially trading the turning point from phase 2 back into phase 1. So looking for your confluence of factors all coming together to suggest the market wants to turn and head back into its overall strong trend. So that's point 2. So point 1 is looking for your shallow retracements on the daily chart. If we can't find those, is looking at lower time frames to enter on. Again, still looking for your confluence of technical factors to enter. And then finally is the most aggressive way to get into the market, which I do on occasions, not all the time, but I do on occasions. So we obviously had the QE announcement, which we'd been preempting now for several months. We've already mentioned this on previous videos. We've been preempting the launch of QE for quite a significant time. But on Thursday, they announced it and confirmed it, and more importantly, they confirmed it with quite a lot of intent. So they said that they're going to be purchasing 60 billion worth of euros purchasing 60 billions worth of currency every single month to devalue their currency pair. So their QE program is going to be 60 billion a month, which is above what the market had anticipated at 50 billion. So that's going to be over roughly 18 months. So in total, it's going to be around 1 trillion's worth of currency, which is incredible. When you think about it, it's a huge purchase. So they have also said that if it's not working, they're prepared to increase that aggression, which the market is seen as very, very bearish. So the euro will continue to be weak for the foreseeable future against the stronger currency pairs. So it's really, really important to bear in mind that we want to pair the euro weakness against strong currency pairs such as the dollar. So in occasions like this, we really won't get that many pullbacks. So we've seen the market just drop. And if you're confident, so this comes with some guidelines, you need to be confident with fundamental analysis. So if you're not, I wouldn't recommend this particular approach. But if you're comfortable with fundamental analysis, what I mean by that is you know how the market will interpret certain news. So I knew pretty confidently that the market would interpret a QE program of 50 billion per month or more as very, very bearish for the euro, especially against the strong dollar. So in that case, we can on occasions just literally sell into the market at market. So going live. We're not waiting for retracements. We're not waiting for pullbacks into resistance, etc. We're simply selling at market with a reasonable size stop, putting stops potentially above major highs, major resistance points. So what you'll find is that you're increasing your risk in pips on the trade. Don't worry, you're not increasing the amount that you're risking. It's just the amount of pips. So you might have a 100, 150 pip risk on a trade purely because you're entering at a relatively bad price. So you're having to put your stop quite far away from that price to ensure that it's protected. So literally selling at market because you're confident in what the news has come out and what it means, i.e. the market's going to start selling the euro against strong currency pairs. Entering in at the market once that has been confirmed, and having a decent stop above resistance, or if you're buying below significant support, and then just holding the position out. Now, you're not getting the best possible price there, but you are trading into strong sentiment, strong fundamental bias. It's not a technical approach, it's just a fundamental approach. And in this case here, we'd have done okay from selling at market in this particular example. The only downside with doing that is sometimes the interpretation of the news is a little bit cloudy, and what that can mean is you're sat in a drawdown for a period of time. So if you're not getting the best, most efficient price, what you could do is be sitting in a negative position for quite a period of time, which isn't nice for any trader. So that's the only downside, and this is the most aggressive way to get in the market. So I'd only urge you to do that if you're pretty comfortable with fundamental analysis and know the reasons why you're getting in, and obviously the added risks that comes alongside that. So really 3 approaches is ideally on the daily chart, we're looking for those decent pullbacks to significant levels of resistance. However, we don't always get that when the markets are trending fantastically like they are now. So you want to be looking for shallow retracements on the daily charts, using your steep trend lines, using your 38% Fibonacci, and maybe a shorter period moving average, such as the 20 moving average. If you still can't find those decent retracements on the daily chart, then it's dropping down time frames, looking at the 4 hour, the hourly, and maybe the 30-minute. Again, looking for the same sort of things, but you're getting more retracements on a lower time frames to get the better price. And then finally is in extreme circumstances is really just selling or buying at market when some fundamental news has confirmed that the move is likely to continue in that direction. Don't just be jumping in at market for no particular reason. Always go in off the back of a strong reason, i.e. there's been a rate cut or a rate hike in a particular nation. You normally get strong moves off the back of that, such as what we saw in Canada recently. Or there's big QE programs, so it's big news that has strong impacts on the market, but you need to be comfortable and confident in terms of how the market's going to interpret that. So if you don't have good fundamental analysis and don't understand how a certain piece of news is going to be interpreted, I'd just leave that particular approach and just concentrate on approach 2, which is just looking at lower time frames. Okay, so I hope that helps. Great thing is the markets are moving. We have had periods in the FX markets where there's really the dollar's very neutral against very neutral currency pairs, and when everything's neutral, you don't really get that much movement. It makes it a little bit trickier to take some decent pips from it. The only downside with trending markets is you never know when they're going to get to the point where they do pull back. So for me, my approach is to, rather than sit in and hold positions for a long period of time, I'm in and out over a much shorter duration. So I'm looking to get in and get out quite quickly, because I don't know when the market is going to have that really strong pullback. Like we're seeing on the euro, is get in, get out, get your pips, because we don't know when the euro on the daily chart is going to have that significant 300, 400 pullback. We just don't know. So get in and get out as quickly as possible. Look to enter off the back of a phase 2 and then exit on previous lows or previous highs. Get in and out, get those pips, but do it on a regular basis, so those small amounts of pips add up over 5 or 6 trades. Okay, and then wait for those decent retracements, which we will get. We will get retracements on the euro daily chart as people start to bank profits, but as soon as that happens, we're looking for the best possible price to get back in and start selling the likes of euro or buying the likes of dollar CAD, etc., because the eurozone is going to be launching QE in March, so we can see some sustained pressure on the euro for the foreseeable future, but there will be periods of time when the market does pull back. So be waiting and ready for when that happens. Anyway, I hope this has helped and given you a few little ideas in terms of how to best take advantage of the market conditions that we've got coming right now and likely to continue for the foreseeable future. So I'm going to wrap up there, leave you to do your thing, and look forward to next week. We've got some very interesting things coming out next week. We've got the Fed statement. Are they going to give any hints away in terms of potential timing of the rate hike in the US? If they are, we should see the US dollar continue to remain strong. We've also got some inflation figures out of Australia again. That could lead to some further negativity on the Australian dollar if their inflation figures are low. And also we have the rate decision from New Zealand, which could be very, very interesting as well. They have been raising rates, but there's some talk that they may come out and announce that they have to keep them on hold for the foreseeable future. So just like with the Aussie, we could see some weakness go through the Kiwi dollar. So lots of things coming out next week which could give us those all-important extremes between strong and weak currency pairs that we know are critical to give us these lovely moves that we've currently been seeing over the last few months. So I'm going to wrap up there. Enjoy the rest of your weekend, and I'll speak to you very, very soon. All the best.